Everywhere you look, people are talking about AI stocks, tech booms, and easy money. It feels like everyone is getting rich, and if you're not in, you're missing out. But history tells us that this kind of market euphoria doesn't last forever. In 1999, during the dot-com bubble, Warren Buffett was one of the few investors who didn't buy into the hype. He warned that markets wouldn't perform as well in the next 17 years as they had in the previous 17. At the time, investors laughed at him, convinced that stocks would keep delivering double-digit returns every year. Buffett was right. Less than a year later, the bubble burst, and the S&P 500 lost half its value. And over the next 17 years, the annualized return was just 2.77%, a fraction of what investors had expected. So is history repeating itself today with the rise of AI stocks and the so-called Magnificent Seven? Let's take a closer look. Buffett's caution in 99 came from a deep understanding of market cycles. He compared the dot-com boom to the rise of the auto and aviation industries in the early 20th century. While both industries changed the world, most of the companies and investors bet on went bankrupt. The same thing happened in the dot-com era. Companies like Pets.com, Webvan, and Global Crossing were household names until they collapsed completely. Even giants like Amazon lost over 90% of their value before eventually recovering. Just because an industry is the future doesn't mean every company in it will succeed. Fast forward to today, and we're seeing eerily similar signs in the market. The seven biggest tech companies, Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla, have been soaring to record highs. These stocks now make up over 30% of the entire S&P 500, a level of concentration not seen since the dot-com bubble of 2000. Investors are piling into AI stocks, convinced that companies like Nvidia can't lose, the same way once thought about Cisco, Intel, and AOL. But history tells us not every company riding a major technology shift will survive. Even companies that seemed unstoppable can become overvalued. Nvidia, for example, is trading at the price to earnings ratio of over 50. That means investors are paying 50 times the company's annual profits, a level that assumes unstoppable growth for decades. Legendary investor Howard Marks recently published a memo called On Bubble Watch, warning that today's market shares many characteristics with past bubbles. He identified four key signs: irrational exuberance, investors blindly chasing stocks believing prices can only go up; outright adoration of certain companies, stocks like Nvidia, Tesla, and Meta being treated like they can't fail; FOMO, new investors rushing in, convinced they have to buy before prices go even higher; the belief that there's no price too high, people saying things like it doesn't matter what it costs, it's the future. All these behaviors are happening right now in the AI space. People are throwing money at anything AI related, convinced that it's the biggest shift in technology since the internet. Maybe they're right, but that doesn't mean these stocks aren't overvalued. Back in 1999, Warren Buffett saw these exact same signs. He wrote that during bull markets, a crowd of investors joins, not because they understand fundamentals, but because they think it's a mistake to be out of stocks. At the peak of the dot-com bubble, a survey found that new investors expected the stock market to return at 22.6% per year for the next decade. The reality, they lost money for 10 years straight. Buffett's advice was simple: focus on valuation, not hype. Just because a stock is in a hot sector doesn't mean it's a good investment. Look at earnings, revenue growth, and long-term sustainability. Diversify. If all your money's in tech stocks, you're exposing yourself to huge risks. The dot-com crash wiped out entire portfolios that weren't properly diversified. Don't time the market. Be in the market and be cautious. You don't need to sell everything, but recognize that not every AI stock will be a long-term winner. Look for companies with moats. Buffett always says the best investments in businesses or with durable competitive advantages, which AI companies actually have one. Right now, Nvidia is making money selling hardware, but not one of the AI software companies are profitable yet. Patience beats speculation. If a company is truly great, it will still be great after the correction. You do not have to buy at the peak. The AI revolution is real, just like the internet was real in 1999, but that didn't stop the majority of dot-com stocks from collapsing. The real winners like Amazon took over a decade to fully recover. Right now, investors believe AI stocks can't lose, but that same was said about the internet stocks in 1999, housing in 2007, and crypto in 2021. If there's one thing we know is that the market bubbles don't last forever. Buffett and Howard Marks won't tell you when the market will correct, but they will see the warning signs. The question is, will you pay attention? Let me know in the comments. Do you think we're in a market bubble or is it different this time? Thanks for watching, and we'll see you in the next one.